Ladies and gentlemen, welcome to our 2025 edition of the German Debt Report of the IREBS, the International Real Estate Business School of the University of Regensburg. This year, we titled the report with More Competition in a Very Calm Market. I would like to say thank you to our sponsors, to Bulwin Gesa, CREFC Europe, Intreal, MSCI, and DECIA. We also say thank you to our supporter, VDP, Verband Deutscher Pfandbriefbanken, who support us with data, contacts, and of course, the banks are also very welcome. The way we did the report did not change over the years. So we have a data questionnaire and we have interviews that are structured, but that gave room for all the partners to state what they really wanted to say. So it is data and sentiment both in one. The data questionnaire and the interviews were provided by these partner banks. So thank you also for all these participating banks. In a summary, for those who want to skip all the rest, we have an age of uncertainty, so this continues. It's not only driven from real estate, it's driven primarily from geopolitics, from macroeconomics, and this is bringing a lot of turmoil to the market. What is more, there are some subsegments who are still burdened with structural changes, and these structural changes are not going to end. So overall, this brings the banks that want to make business, who obviously want to go back to business, into a situation where shall they land? And they all end up in a comparatively small core segment. So they're jumping literally all on the similar segments. We'll talk which these are. So this leads to more competition in these highly liquid, highly searched for markets, but it leaves less competition to those markets that are not sought for. Office is one of these burdened markets for the last few years and stays so for longer. So the banks were mirroring that they are staying away from office financing to most extent, and they are trying to shorten their portfolio, reduce their portfolio with regards to office. Of course, they are financing office. Office is still one of the most important segments of overall commercial real estate lending, but at a much lower level than before. So this means core office in the top locations that are fully let, energy efficient. These are one segment that is highly searched for, but the remainder in the smaller cities in the periphery that is not fully refurbished has still to struggle. Regulation has been always a topic in all interviews that we had. Regulation is still considered to be very tight. The latest changes in regulation have not really improved much of the burden, and the banks also reflect that they observe some asymmetry in regulatory access, because if banks are regulated very tightly, this gives more room for the non-regulated, non-bank financing, also outside the mezzanine segment. Last point, we thus expect, given this pressure on the market and considering the regulatory pressure on the banks, that consolidation is still continuing over the next couple of years. So let me start with the first segment, namely the market perception. This chart shows where the banks believe that competition is going. Every bar that is red indicates that the banks perceive competition to be getting more intense than the previous semi-annual. So this means for the last 3.5 years, banks were reporting that they believe that competition has been increasing. Before that, they saw competition was easing, so they were able to ask better margins. Now it seems to be more a mixed bag. So that means they see more competition where they want to do business. They don't see competition where they don't want to see business. So this means this leaves banks with a comparatively uncomfortable position, because it means that either they face competition or go to segments where they don't want to be. The overall lending volume has been declining over the last 3 years, but banks believe that it's going to be stable or even increasing at double digits in 2025. So why do I say they believe it's consolidating or stagnant or even increasing? Most banks reported that the first half year was still muted. So that means that their overall transaction volume, the financing volume, has been stagnant, but their perception for the second half of 2025 was positive. So by and large, this could be a forecast of double-digit growth, but so far it is not yet on the books. The overall loan book has been growing slightly because there were repayments that were not very strong. One of the most important charts already in last year was this one. It shows the maturity structure of the loan book. So this chart is even more strongly shaped V than in the previous year. Last year, I already highlighted that we see a very strongly increasing window for maturities in the next year. That means for the now 2025, and this now has increased dramatically. So that means a significant share of the loan book has been postponed only by 1 year, and that means that the chunk has been growing. The share that has a long-term maturity has been staying stagnant. That is comparatively good, but this means that there will be remaining pressure for 2026 to come. This is maybe one of the biggest challenges for the next year. So this also means this will be a challenge, particularly for the commercial real estate lending, namely office, logistics, and maybe institutional nursing homes and all that. With regards to institutional and residential, the situation is significantly more benign. The maturity structure is more benign with much more long-term financing, which is typical for residential, but that means the chart that I showed you before was only half of the story. Banks are still not searching their happiness outside Germany, so they're having a strong focus on German customers, and the volume that is transacted and financed with German bank money has been comparatively stagnant over the last 10 years. The key countries where they are going, it's of course still France, UK. It was interesting that banks are still looking favorably on Italy, of course, northern Italy, then rather overall. For the last couple of years, we took this chart as a comparatively good risk indicator, saying that repayments that are extraordinary, particularly, have been shrinking over the last years, indicating that there is more pressure for the banks and low transaction and low price expectation still. This has flattened in 2024, and the banks were reporting that they believe in a stabilization. But this has been not yet a strong pickup, so the pressure will remain high, but it is not increasing. And we believe that we are therefore at least in the vicinity of the trough, but it's not yet a upswing momentum visible. This is also because some of these segments that needs finance are still burdened. This is the chart signaling the sentiment, the real estate climate for German real estate asset classes. And you see that particularly office and retail are still below the 100 index points level. 100 index point is therefore important because every value above 100 index points signals growth. Every index point below signals rather shrinking market environment. So this means on the positive side that not only residential and logistics are positive, but also hotel climate has been improving over the last couple of quarters and has been finding its way back. And this is what the banks also indicated, namely that they are more willing to finance hotel again. But the biggest commercial real estate classes, office and retail, are still at risk. And this is also showing this chart, where the shift of different chunks of financing of the banks is still not in favor of office or retail. But you see also in this indication that the banks give, where they would like to do more business, that hotel has improved over the last couple of quarters. With regards to office, we had a special section on office this year. Office is by far the most burdened segment as viewed by the banks. Here you can see the lower end parts of the bars. That is signaling shrinking, and the light blue, the medium blue, that is some banks, approximately 45% of the banks were signaling that office might return to meager growth. But the majority was still perceiving that it's rather to shrink than to grow. And this is different for literally all other asset classes. For most asset classes, the banks expect some growth, not strong growth for retail, but significant growth for residential, hotels, and also logistics. But office is a little bit burdened on its own. So, and this is going to continue. All banks that we are talked on average were believing that they need to shrink their office portfolio over the next 3 years still. Of course, some banks were saying we are almost done, we are pretty close. So this does not say that all banks are going to shrink their portfolio over the next 3 years, but on average, they are rather towards shrinking than growing their office portfolio. Similar like in the last few years, there is no big deals at the moment. Banks are financing small deals, focusing on liquid markets, trying to do more deals together with other banks. So all this is putting pressure on the bigger deals, and there's also pricing pressure. And of course, this is burdening particularly Berlin, because Berlin had such a high level of financing and transaction volume, so that this has been rather pointing down. But the significance of the Berlin momentum downwards is unexpected to our view. So we see that the sharpest decline compared to a previous year is now reported for last year in Berlin. So, and the smaller markets, Stuttgart has been, and Hamburg have been benefiting from that, and Frankfurt is picking up, maybe thanks to international capital going in. Of course, in this current interest rate environment, without all these uncertainties, developers are still not in favor. And similar with the repayments that I showed you before, the project developments are still shrinking in overall share. That means that also for the next years, the pressure on repayments will stay significant. And this also means that pricing pressure on new developments will remain high. A similar picture is painted by the data from the IFO Institute in Munich. Orders are cancelled, building permits are still low, even though for residential they are picking up from very low levels, but modestly only so far. So therefore, overall caution seems to be the guide for the next year. And banks are still keeping their LTVs comparatively low. Consider that this increase on LTVs is also partly driven by a drop in prices. So therefore, the cautionary environment is still significant. And of course, this happens particularly for project developments. Banks call for significantly more equity or mezzanine financing in new developments. You also see that the variance of the banks has been slightly increasing over the last couple of years. So there seem to be some banks already trying to move into this segment where margins are a little bit more favorable. So when I say banks are more careful with project developments, they are calling for more equity, more mezzanine financing in project development finance. So this is also mirrored in this chart where we ask them, where do you see the role of mezzanine finance? And more banks than in the past were saying we believe it's to increase because we cannot do that anymore. Interestingly, this year, the banks were not only saying that it's mezzanine finance as a second pillar to financing environment for project development, but they were referring that there is more competition coming from whole loan lenders and non-bank lending also in traditional banking environments. So therefore, it's not only the mezzanine that they are believing to increase, but also non-bank lending that seems to be picking up and benefiting from the current environment. And here, similarly as before, IFO Institute's data adds to this information where they report that there's caution is still advised, that credit negotiation still taking longer and are more difficult than in the past. So why are margins then on the one hand under pressure and still going up? Because the portfolios, of course, mix these two things. On the one hand, you have a severe pricing pressure in the top locations, and on the other hand, you have no pressure in the more risk appetite tranches. That means in the periphery. So therefore, you see this movement towards rising margins, not so much because banks feel stronger in all segments, but because they can do in these risky territory. And this holds for literally all segments, but of course it holds a little bit more for commercial than for residential, because residential is much more searched for. The fees have been in decline, but the changes over the last years have been comparatively small. So therefore, I don't want to overstretch this feature for commercial project development lending, and will rather start to talk about the regulatory environment. In the past years, regulatory was to a significant share, a significant part on green regulation. The taxonomy and even the ECB were looking very deeply into green finance and try to give more guidance how to increase the share of green finance. So we were asking, is this still continue? But let me start with the Basel III finalization, because that has been over the last decade always the question: how much of additional margin pressure will be created due to Basel III finalization? So we asked the banks, how much do you believe that margins are going up due to this finalization? Between 0 and 35 base points, they reported. That is somewhat smaller than they estimated in the past. This can be two reasons. First of all, they overestimated the pressure, or they already adapted some of the challenges in the past. So therefore, the overall impact could be bigger than the finalization impact itself. But it means that the regulation has its price, obviously, because literally no bank reported that they were able to lower the margins, of course. We also asked them about the sectoral capital buffer. The sectoral capital buffer was started as one segment of macroprudential regulation, where BaFin wanted to have the banks giving additional risk capital due to volatilities on real estate markets. And the sectoral capital buffer was started 2 years ago with particular view on residential real estate financing, asking additional capital buffer for residential finance. This came to somewhat a surprise because residential markets were believed to be rather stable, more stable than commercial real estate. But of course, the BaFin could argue residential financing is the biggest part. So if you want to stabilize the overall market, if you want to have a macroeconomic stabilization, rather start with residential than with commercial. So banks were criticizing this movement because, of course, it made also residential real estate financing more expensive. So now the BaFin has lowered this capital buffer by a few base points, and we asked the banks how big would be the impact of this regulatory change in favor of their potential, and they said, well, comparatively small. So the regulatory change now in 2025, lowering this sectoral capital buffer for residential, will not change the market. It will not make residential financing easy or cheap or anything. But this also shows that most likely the impact before was not very strong. So it meant that this capital buffer led to additional transaction work with not much change in the overall financing behavior. So we headlined this chapter on regulation with the end of green finance, and I said now. There is a lot of discussion about does ESG still matter, environmental, social, and government regulation, does it still matter? All banks reported, yes, it does. It is somewhat lower than in the past, but it still matters a lot at different speed. Office and residential and logistics are most often addressed. When it comes to how important that is, well, logistics primarily because it's new builds, residential because it's required, and office because currently the most transacted and most financed real estate is in the city centers, the best locations, the core properties, and these are usually ESG compliant anyway. So therefore, office is reflecting a little bit the focus on core. Residential is reflecting a little bit the regulatory environment towards residential anyway, and logistics is reflecting the new build. So is ESG a competitive edge? Not so much as in the past. So all banks seem to be following the same strategy. And this also means that there is some margin pressure upwards. So they are giving some incentive to make green finance. But if everybody is doing the same, this will be comparatively small. And this is what we see also in the data. This is pretty much in line what we see from academic literature trying to estimate the improvement on margins given ESG compliant financing. So there is some positive effect. That means banks are willing to compensate a lower ESG risk, but this impact is comparatively small. So overall, the age of uncertainty, as I started the little presentation, is lingering on. The uncertainty indices that we have, for example, here the World Uncertainty Index on the global level points a sharp increase globally, but also for Europe and also for the United States. It's still continuing. And of course, this uncertainty is bad news in a world that is already struggling with a meager upswing. But there is some positive signs for real estate, particularly for residential real estate. I brought you here the data for Google search volumes for real estate related items, namely house purchase, apartment purchase, property purchase. So all these have been going up a little bit over the last couple of quarters. This is still intact. So search volumes is not a transaction, but still, if you want to transact, you first rather search. And of course, for commercial, it might be argued that commercial transactions don't need Google or ChatGPT to search their interest. However, there is academic literature indicating that even commercial real estate transaction can be forecasted with Google search volume data. So therefore, it's still valid to look at that. The banks in this age of uncertainty do not expect significant leeway for further interest rate cuts. They believe interest rates will remain comparatively stable from now on, maybe one, maximum two interest rate steps by the ECB. But on average, most banks were pointing towards very stable interest rates. So this means there is some movement towards normalization. That means some light at the end of the tunnel, as I say. There is some stabilization in interest rates, but this is not yet enough that the pressure on the loan books will ease quickly. And we see already that in the past 2 years, the portfolio, the NPL portfolios have been picking up. For commercial, it has been going up already earlier, but even for residential for the last 2 years, it has been tilting up. And the banks were reporting that they are expecting a stabilization on elevated levels at best. So most banks said we expect stabilization, but some banks pointed that the further increases are reasonable to expect. So this is overall absolute level. So if you put that into perspective, because of course the overall loan values have increased, the shares of NPL volumes are compared to the overall loan book are still significantly smaller than after the last crisis, after the great financial crisis, but they are significantly bigger than before COVID or even shortly after COVID. So this means there will be some NPL-induced transaction most likely going on in 2026. So summing up, what are the opportunities and risks? I think I talked a lot about risks still. So geopolitics, the business side, liquidity, and market consolidation as a result. Interestingly, the banks were pointing, let's say, to more these hope-induced indicators on opportunities, namely that there will be some cyclical return, that there will be some federal investment programs that benefit. They don't yet see the hard opportunities that might be there. It's more like a hope than a hard data upswing that we currently see. The segment on the opportunity side is of course logistics and residential. The segment on the risk side is of course office. Interestingly, we didn't talk here in the opportunities and risk a lot about ESG. The highlighted items are those which were mentioned most often. The others were mentioned once or twice. If you want to learn more about the report, you can contact us, either Simon Wiersma or myself. At these email addresses, you will find further information how you can study with us at our webpage. Thank you very much.